Okay, let's unpack this. If you're someone who tries to, stay informed, you read the financial news, you listen to the commentary, especially about these huge, fast-moving sectors like AI, you've probably felt this.
Oh, definitely.
Read an analysis, it's brilliant, it's logical, all the data's there, but somehow when you're done, it just doesn't fully land.
Right. It doesn't feel wrong. Exactly. Just
Incomplete.
incomplete. And that feeling, that sense of a disconnect is exactly what we're digging into today. It happens when we try to apply what is really a perfectly sound, logical, linear explanation to a reality that's already, well, it's not linear at all.
So, the analysis is valid on its own terms. But you have this nagging feeling that there's this whole other thing happening underneath that the usual metrics just aren't designed to track.
Exactly.
And that's our mission for this deep dive. We are not here to judge the news or say the analysts are wrong. Not at all. Instead, we're going to give you a kind of conceptual framework, we're calling it the Eco-Prism, to understand why that feeling of incompleteness pops up.
Think of the standard market story as like a beam of white light. It looks like one solid thing.
Our goal is to use this prism to refract that white light, to see the whole spectrum of what's really going on underneath. We're focusing on observation speed and phase.
It's about moving from just consuming the news to actually, decomposing it. When you can see the premises and the speeds where an argument is true, you stop treating it as this single absolute truth. It becomes one piece of evidence.
It gives you a three-dimensional view.
That's the goal.
Okay, so let's start with that white light. Let's start with the standard market commentary. What is that narrative, and why does it feel so consistent and so valid inside its own box?
Well, the standard narrative, especially when you're talking about sectors that need a ton of upfront investment like AI, advanced computing, that kind of thing, it's intensely focused on the market's own internal discipline, the idea that the market will and should regulate itself.
Okay, so what are the specific claims that build that view? Because you see them repeated everywhere.
They almost always break down into a four-part cycle. First, the observation that capital circulation is getting distorted. Too much money is chasing too few things too quickly.
Okay.
Second, they argue that investment and real on-the-ground demand are getting tangled up in what they call circular trading.
Right, let's pause on that for a second. Circular trading.
Yeah.
In the popular press, that basically gets translated as investors are just selling to each other at higher and higher prices.
That's exactly it. From the market's point of view, that's when capital starts chasing other capital. Instead of chasing, real profits or actual customer demand, it becomes the self-fulfilling prophecy where valuations get inflated just because everyone expects more investment to come in.
Not because the company's actually making more money.
Precisely. And that's what blows up the valuations.
Which leads right to their third point, doesn't it? If capital is just chasing capital, you start seeing signs that look a lot like past bubbles. An overheating system that just can't last.
That's right. And from there, the conclusion is inevitable. That's the fourth point. Market discipline is required. A correction, often a really sharp and painful one, is seen as necessary to just purge the system and get price and value back in line.
And look, if you're operating purely within the world of finance, that analysis isn't just compelling. It's incredibly logical.
Oh, it is. It's highly sound because the claims are absolutely valid if you accept their foundational premise. The premise is that the market is the ultimate and sufficient evaluation device, that price and value have to align in the medium term, and that the only way to fix things is through the market's own internal mechanism, the movement of capital. If you accept all that, then yeah, circular trading is a massive danger signal.
Good. So we have to acknowledge that the analysis is basically perfect within that capital flow framework.
Yeah.
But here's where we get to the core of it. Here's where the ego prism comes in.
Yeah.
If that analysis is so sound, why does it still feel like something's missing? Why do we have that nagging sense that even if a huge correction happens, even if investors get wiped out, the underlying project, the technology, it's not just going to stop?
That feeling, that discomfort, that's the signal. It's the signal that we're applying a correct but linear explanation to a reality that is fundamentally nonlinear. The hypothesis is this. The market analysis is fine, but it only works if markets are the only place where real change is happening. And that feeling of discomfort tells you they're not.
So we need the eco-prism to, separate the signal from the system. How does this tool actually work for someone listening?
We see it as a decomposition device. It takes that linear white light of the economic news and it breaks it apart. And crucially, you're not using it to argue with the conclusion like, is the market overpriced? No, you're using it to question the scope of the observation. Its purpose is to help you see the premise and the speed at which any statement is true. It's like, imagine the market is looking through a microscope at a cell dividing really, really fast. The prism reminds you to occasionally pull back and look at the whole organism, its environment, and the speed at which that whole thing is growing.
That makes it much clearer. So we're challenging the domain of the analysis, not its internal logic.
Exactly.
We accept the market claims, but we use the prism to see these unobserved territories that are just operating on a totally different clock.
And that feeling of inadequacy, it really comes down to a velocity mismatch, a difference in speed. Which brings us to this idea of fast cycles versus these slow, irreversible phase shifts.
So if that feeling comes from a difference in speed, we have to talk about that. I mean, how big is the gap between these different layers?
It's huge. It's massive. Market commentators, they are masters of the short term. They capture the cyclical speed of capital, of sentiment, of quarterly expectations. It's a world of cycles.
Boom, bust, recovery, repeat.
Right. It's super reactive. It's focused on the next 3 to 12 months. We call these the fast movers.
And the fast movers are what dominate the news cycle.
Completely. Stock prices, valuation multiples, the speed of investment, the narratives that swing from, euphoria to panic. They are essential signals for an investor.
But then you have what our sources call the slow movers. And these aren't cyclical at all, are they? They're structural. They change things for good.
They are the true systems. I mean, think about the fundamental long-term need for a technology like AI or for a new kind of infrastructure. That underlying demand doesn't just vanish because a stock price falls 30%.
Of course not.
And even more importantly, you have structural competition, often driven by geopolitics, by national strategy. That stuff operates on a decade-long timeline, not a quarterly one.
And the biggest change of all is what the sources call irreversible dependence. When a new technology becomes just part of the furniture, it becomes infrastructure.
A phase change. Once that dependence is there, like with the power grid or the internet, you don't cycle back from it. It's done.
Can you give us an example?
Sure. Think about the railway boom in the 19th century. There were massive, repeated financial panics, total fast mover cycles driven by speculation and debt. Yet through all of those busts and booms, the tracks just kept getting laid. The slow, irreversible dependence on a continental transport system just grew and grew, no matter what the financial markets were doing.
So the fast cycle was detecting the immediate financial risk.
Yes, the fever of speculation. But the slow shift was the underlying unstoppable necessity of building the infrastructure.
That's a crucial point. It suggests that both things, the fast market cycle and the slow structural shift, they might actually be detecting the same distortion, just from completely different angles.
Different observation phases, exactly. The market sees a fever. The structure sees the necessary ongoing cost of a massive transformation.
Which lets us ask a much better question than just, is this a bubble?
A much better question.
We can ask, is the market's adjustment signal, the fast mover, strong enough to actually stop the structural necessity signal, the slow mover?
And in the case of something becoming irreversible infrastructure, the answer is very often no.
So the market is screaming, overheating, we need an adjustment.
While the structural layer is basically saying the world is changing and this requires massive investment, period, regardless of the cycle.
And now we can use the eco-prism to really define the blind spots in that market commentary. So what is clearly visible through that market lens?
Well, you can clearly see the capital flow getting distorted. You can see market psychology, the need to protect investors, the investment cycle itself. That's its job.
That is its domain.
But the discomfort, that feeling, tells us that's not the whole story. So what are those specific unobserved territories? What are the structural blind spots?
There are three really critical ones that the market lens tends to filter out. First, that phase shift we just talked about, a technology like AI becoming foundational, irreversible infrastructure.
Oh, yeah, what's the second? The second, and this is so important for understanding how these things get built, is the potential for non-market capital supply.
What do you mean by non-market capital? Is that government money or?
It could be. It's any capital from a source that isn't primarily motivated by quarterly profit or short-term return on investment. So it doesn't operate under the market's definition of discipline. This could be state funds, defense budgets, or huge institutional investors who are acting on long-term strategic priorities.
So if the market panics and pulls its funding, the actual project, the build-out, can just keep going with money that plays by a different set of rules.
Precisely. A rule set driven by necessity, not immediate profit. It just fundamentally changes the feedback loop.
And the third blind spot.
The third is that the market analysis often misses the growing gap between the short-term market price and what you could call the underlying long-term collateral value of the tech itself. The market price goes up and down. The value of the infrastructure, once it's built, is sticky. It's irreversible.
This gives a totally new way of looking at that idea of circular trading.
It does, because if you look through the Prism, that circular trading that market commentary hates so much, it might not just be a self-serving game for investors. It could be functioning as a temporary funding pump.
A funding pump?
Yeah. It's highly inefficient, sure, and it creates a lot of noise and distortion, but it might be the thing that successfully pulls huge amounts of private capital toward the real-world build-out that the structural layer needs.
Wow. So even though the valuation mechanism looks broken, the capital is still doing productive work building that slow, irreversible foundation.
The fast movers are frantically signaling risk, but in the process, they're accidentally providing the fuel for the slow movers.
That's the key insight.
It is. Even if the market evaluation shrinks, the correction happens, stock prices collapse, the funding for the core technology can just continue shifting to a different form, institutional, public.
And that misalignment, a market correction that is completely disconnected from the actual survival of the technology, that is the precise reason the news feels incomplete to you.
The adjustment signal is deafening, but it only applies to the high-speed capital layer.
Not the slow, irreversible layer that's going to define our future systems.
The commentary isn't wrong about the capital cycle. It's just spectrally incomplete.
That's the real power of looking at it this way. The issue isn't about analysts being right or wrong. It's that you're getting claims from the market, which operates in a linear space. And they're being presented as the whole truth without being broken down by the prism for a reality that is fundamentally non-linear.
And the framework lets you recategorize that commentary. So instead of hearing some pessimistic analysis and thinking it's an obituary for the technology, you see it for what it is, a necessary adjustment signal coming from inside that high-speed capital layer. It's a warning about portfolio risk, not a verdict on structural change.
So this tool, the Prism, it's not designed to tell you whether to invest or not.
No, not at all.
It's designed to give you a richer, more contextual way of understanding what's at stake.
What's really fascinating here is that the goal is to make your understanding three-dimensional. So the next time you hear a story about a potential market collapse, you can filter it instantly. You can ask, is this a fast mover warning about capital flows, or does it genuinely challenge the slow mover reality of irreversible dependence?
And that's a fundamental shift in how you see the world. So if a technology's transition to irreversible dependence operates on a timeline that's so much slower than financial cycles, we have to ask, what critical infrastructure that defines our world today was built despite, or maybe even because of, a major market correction that weeded out the speculators but left the essential project standing? That's something for you to mull over as you start to use the Prism on the next cycle that unfolds.